the longer that headline rate's above target, I guess the trickier it gets, and the more questions, I suppose, about whether they're doing their job and how long can they hold their nerve.
Kia ora, and welcome to New Zealand Property Market Podcast, brought to you by Cotality for the 28th of April 2026. I'm Head of Research Nick Goodall, and today I'm joined, as per usual, by our Chief Economist, Kelvin Davidson. Kelvin, I'm really keen to hear about your experience visiting the fancy new stadium, of course, for Super Round. But first, we've got a pretty important, if slightly predictable, economic data point out last week. That was, of course, the CPI inflation data for Q1. Do you want to take us through the data and the market reaction to that data too, mate?
Yeah, well, gee, I mean, it was probably sort of a bit ho-hum, really. I mean, we still had inflation above target, which is far from ideal, but everyone was expecting it. It was, it was going to be around 3%, whether it was going to be 2.9 or 3.1, which it actually was. It didn't really generate a lot of interest at all. I mean, everyone noted it, but moved on pretty quickly, I would say, because it's the whole calm before the storm, line in the sand, whatever analogy you want to use. We know it's going to be worse in the current quarter and potentially after that, depending on how long this all goes on. But yeah, Q1 obviously only being partly affected by the Iran conflict, that number was always going to be sort of a bit dull and people would move on pretty quickly. But yeah, I mean, no denying it's still above target, so 3.1% in the first quarter, same as it was in Q4 last year. So still just running slightly above that 1 to 3% medium-term target band that the Reserve Bank has. The breakdown was, I mean, you can go down obviously to a very granular level and find things that were up and down and sort of moving over around the place, but that sort of broader tradables or sort of imported type inflation was 2.5%, just slightly down from 2.6% in Q4. And non-tradables held pretty much unchanged at 3.5%. So, there wasn't a lot to note in there either. It was just sort of tracking sideways. And yet, let's not lose sight of the fact it was above target. But yeah, no real massive surprises. I mean, like I say, we only had 1 month of Iran in this, so there were 2 months of sort of normal inflation data, and yes, petrol prices would have, and diesel and that sort of thing played a role in March, of course, and pushed up the overall quarter's inflation rate. But I think from memory, reading the Stats NZ release, those things had actually fallen in January and February, so possibly the overall impact of fuel prices across that quarter wasn't as big as what people had thought. So, the overall number was a little bit sort of more controlled too. But yeah, so I mean, it is what it is. We'll move on. Q2 we know is going to be worse, and potentially into Q3, and who knows beyond that as well. I mean, still the tricky balancing act from the Reserve Bank with saying, okay, we're prepared to look through these initial inflation impacts, and we know the spare capacity, and we know the economy is going to slow, but at the same time, you're worried about those wider price impacts feeding through second round inflation in terms of expectations and wage demands, and so therefore, I suppose the big question is still, we know we're going to get an official cash rate increase at some point. So I suppose the big question, which was around before these CPI numbers, is still around now, and so there's still uncertainty about it, is when we get that first cash rate rise. And I mean, different people have different views, but it does feel like there's a sort of marketing type or perception type issue here from the Reserve Bank. It's all very well to talk about spare capacity and second round inflation and all these things, but the longer that headline rate's above target, I guess the trickier it gets, and the more questions, I suppose, about whether they're doing their job and how long can they hold their nerve. So those questions are still around. I don't think we're necessarily any clearer on those as a result of the CPI number, but yeah, lots of people speculating now about a cash rate rise in July. I just had a look at the dates for the meetings. We got a monetary policy statement on the 27th of May. So even that's still a month away. A lot can change in that time. And then after that, we got 8th of July and 2nd of September. So, I mean, there do seem to be people shifting towards that July rate rise. But yeah, I mean, May's still a month away. Monetary policy statement, full forecast, full chance to sort of spell everything out. So, you may not necessarily rule that out either. So I think that's still the big question. When that timing for that official cash rate rise comes, which pretty much inevitably will, it's just that question of timing. So yeah, one to keep watching.
Yeah, I mean, that's exactly where my head went, right? Is one of the key decision points coming for the Reserve Bank. And so I assume that CPI inflation for Q2 will be essentially 3 months away. So that's late July. I just quickly looked it up, and as long as this research is right, 21st of July might be when we get Q2 data. So interesting to note that's going to be, what, 2 weeks after we get the Reserve Bank's decision on the 8th of July. So when they make that call in July, so that's two decisions away, end of May, early July, both of those are going to be done without the official inflation data. Now, I know we get the price index data, which covers, what, 45% of it. So maybe we get a good feel for what's occurred through most of Q2 by that point, but not the official data. So it just makes me wonder about how much would they want to wait for the official data or to get a great read on what inflation's actually done before making that call to lift the official cash rate in July, let's say? Or do they wait and see? Or do you think they'll have enough by then, by let's say the 8th of July, on an expectation or a good enough read on those inflation expectations for the future? You know, when you're talking about second round impacts, wage demands, those second round effects, do you think by July we'll have a good enough read to know where those things are likely to settle, even in Q3 or later in the year, that the Reserve Bank will have enough at that time to go, okay, now let's not necessarily preempt what that data will read right now. Let's not say what the data's going to say, but do you think they'll have enough data, one way or the other, to either hike the OCR and go, yep, we're worried about second round inflation, and so we're going to do it now to get ahead of it? Or they might also look at that data and go, it actually doesn't look like the impact's going to be so bad. And so they can be comfortable at saying, no, we're going to hold again, still wait in the wait and see mode. Now, I'm not asking you to figure out what the data's going to say by then, but do you think that 3 months of data from now until then might give them enough to have confidence in that July meeting to make a call one way or the other? I realise I'm putting you on the spot here, but what do you reckon?
Yeah, I mean, well, there's the big question of how long this all lasts, of course, and
Of
assuming
course.
it goes on for that period of time, and hopefully it's all wound down, and maybe we're getting back to some kind of normal. Might not be the same normal, but some kind of normal. So I suppose that's a question. I mean, it still feels quite soon to do it in May, so I think it probably is. The question is around sort of July or September. I mean, yeah, I fully take the point that you could definitely see a case for waiting for that official CPI number, which would mean you're not making a decision necessarily until September. And I know I've been doing a few things with the Westpac economics team lately, and their view is definitely that the first rate rise will come in September. After that, it's a series of increases, sort of 4 or 5 in a row. And perhaps part of that rationale was simply waiting to get that CPI number to get some more solid evidence. So yeah, can definitely see that argument. But at the same time, well, like September's 5 months away. It's 4 months away, I suppose, early September. So, geez, there's a lot can happen in that time, and we'll get monthly inflation data for about half the CPI. Yes, they're more volatile elements, but we'll be getting that, and we'll have information on sort of inflation expectations from, say, ANZ's surveys of consumers and businesses. So yeah, it's I mean, I don't know how they're going to weigh out these things. I guess it's in the end it'll come down to that committee about what they do, and there's different arguments both ways. I think it's, like I say, probably May is still a bit too early. It feels like you'd want a bit more evidence, but feels a bit 50-50 on July or September to me, and partly I probably lean, in terms of, I guess, like strong justification, you probably lean towards September. You want to see all that data, but it just feels so far away at the same time. And if this thing goes on for that long, I mean, imagine what we might be looking at in terms of petrol prices if we're getting to, fuel rationing and stuff. So yeah, I don't know, 50-50.
No, fair enough. I think, there are so many unknowns there. And if we keep going, we're just going to be speculating more on what data could say. And that's it, right? Like if inflation data comes in for Q2 and it's at 5%, then that's going to clearly have an impact on what the Reserve Bank do. But if it doesn't even get to 4, some miracle way, like I don't even know if that's possible, to be honest, given we've already seen such a long period of disruption for petrol and gas and fertiliser and all these things. Like it does feel like, we're going to see higher inflation than that. But I don't know. If you put all those scenarios on the table, they're all going to have very different decisions. And that's not even considering those expectations and what signs might there be of those wage demands increasing, right? And that's probably the other thing, is that we don't have all the dates in front of us as to when those other forms of data will come out, which the Reserve Bank might weigh quite heavily on, or lean quite heavily on, and then that could influence what they do, because they do, maybe if they do see a drag on the rest of the economy, which is dragging down inflation in other areas, even though we're fighting against higher inflation for especially things that we're importing, like it's just be interesting to see how that all weighs up. But yeah, I will just leave it there, because I think it is just going down multiple rabbit holes, which we just can't put any certainty to. So we'll just continue to track it, continue to wait and see all the data that comes out between now and then. I think happy to finish on, the fact that, May does look too soon, and it's hard to see any, solid forms of data coming out between now and then, which would lean them towards being comfortable with getting that far ahead of the game. When they spoke about last time, the fact that they were willing to move quickly when required, it's hard to see what between now and then is going to force them to say, hey, we are worried. Well, we can see there's some real impact in the market down the track that we need to get ahead of from an inflation perspective, so sooner rather than later. Hard to see that being the case, wouldn't rule it out, but yeah, it certainly feels like July's the earliest, and then it's going to depend on what data comes out, what that data says, and then their read on that data as well. But yeah, let's maybe leave it there. Let's step back into the property market a bit more deeply then. Last week we put out our chart pack. And as we spoke about last week, when you would sort of focus on this one, on the sales volumes, we'd seen that now that we can sort of, close out the quarter, first 3 months of the year, that we could see that sales volumes were weaker than, they'd previously been, down year on year for each of those months. Earlier in the year, we'd spoken about maybe that was partly affected by transactions being brought forward to December. Now it looks like it's more than just that, replacement of those transactions, and it's kind of persisted throughout the quarter. Do you want to take us through some of the actual data for those sales volumes? I think naturally we're going to have a conversation around what values did in that quarter as well. The fact we've got the index, I know, coming out this week for April, and so any early signs on what you're expecting to see in that data. And yeah, just sort of round out that release of that chart pack if you want, mate. So yeah, just back on that property market data if you want.
Yeah, so we had, it's been a cautious start to the year for sales for sure. I think it was down around about 8% year on year in January, something like 3% in February, and 2%-ish in March. So yeah, you add that up across that quarter and you're down sort of 4%-ish year on year. So yeah, pretty cautious start to the year, and it wasn't so long ago we were talking about potentially sales being up sort of 10% across the year. So it has been a slow start, and I guess some of this or most of this came along even prior to the Iran conflict anyway. So I guess just sort of reinforces that attitudes are still pretty cautious. Buyers and sellers not really in a rush. I mean, sellers aren't necessarily having to capitulate. There's not like forced sales or anything, but they're just sitting on the market. Things are taking a little bit longer. Deal volumes are slowing down. Buyers still cautious as well. Of course, in the meantime, with sales activity perhaps being a bit quieter than what we normally would have thought, listings are always coming onto the market. We're probably into that sort of winter slowdown now in terms of new listings, but we've had the seasonal lift in new listings, so actual stock on the market has remained fairly high too. It's not all that much change from where it was this time in 2025 and even 24. So yeah, there's still a lot of stock out there. Buyers, I guess, will know they still have the pricing power, and it's all just sort of ticking sideways really. And of course, as I say, this largely predates Iran, so you'd have to think that with what we've seen for consumer confidence, business confidence, that there's going to be some upcoming weakness in terms of property sales as well. So yeah, I think it's going to be it's going to be another sluggish couple of months at least, you would think. In terms of home values, we've got our index coming out later this week. It'll be out publicly on Friday. That's for April. Early indications, we have a weekly index, which is totally available on our website. People can go check that out anytime. It doesn't cover every TA, but we've got Auckland, Wellington and Christchurch on there. It looks like Wellington might have been a bit soft in April. Christchurch maybe up a bit. Sort of Auckland, I think from memory, was sort of tracking sideways. So it kind of leaves the national average maybe up, possibly in April, but wait and see when we get those actual figures just to judge that final impact. But either way, it's not going to be up like 2% or anything. It's still going to be pretty flat within the error margins. It's another sort of sluggish month for values. And you'd have to think if listings stay high, sales stay pretty subdued, those small value lifts we had in February, March would tend to peter out, go into reverse. So it does feel like just another sort of sluggish little period we've got coming up. Great for buyers, of course. If you're happy with or comfortable in your job, secure in your job, you can make the sums work. I mean, first home buyers, it's still a good market to be a first home buyer. They're still taking pretty much record market shares, rising number of deals too. Smaller investors, we talked about them. Was it last week perhaps? They've returned in terms of purchasing activity as well. So yeah, I mean, it's if you can make the sums work, confident about your income, great time to be a buyer. So there's always two sides to the coin, I guess, and not so great for sellers perhaps, but really good for buyers at the moment. So that's probably the sort of overall perspective at the moment. The I suppose depending on your perspective on the housing market, the tone of the chart pack was probably a bit disappointing for some, good for others, especially if you're a buyer. But yeah, it looks like we're set for another sort of sluggish little patch for sales and values anyway.
Yeah, I think so. I think when we, looked what the sales volume is going to do for the rest of the year, it does feel like, likely the activity flattens off to some degree. It does feel like, it does feel a little bit glum, bit grim, whatever you want to call it. And that was probably reflected in an interview I did on Herald Now last week, which did sound pretty negative overall. And I think the way that comes across really is because it's a reflection of a weaker economy. And like I said, it's that tough job market, right? It's like we just were talking about the fact that we're likely to see more movers back up there, keen to track to that next property because they can upgrade now, because the economic situation's improving, and so they'll feel more comfortable in their job. And all these sort of positivities that come through from having a better economy and a more solid job market where unemployment is just expected to drop away. It just feels like because that's all been thrown into haywire and we're likely to see a weaker economy and maybe increasing unemployment for a little bit longer before maybe a decline later in the year, that's just going to flow through to that confidence in the housing market, right? And so you are likely to see fewer transactions occur because people are going to come back and sit on their hands. When you are doing a deal, maybe you're not as keen to take on quite as much debt if you're not sure about your own financial situation. And so that means that those prices don't go anywhere, which, as you said, there's of course a positive side to that anyone is active and feeling solid in their job and their income, then they're going to get a much better bargain out there as well. So I don't want to make it all sound like, increasing activity, increasing prices is good for everybody. Of course it's not. But I do think it's a reflection of a weaker economy, and that's why it's often put with a negative tone. So yeah, I think that's the difficult part of this one, I guess. Is there anything else in there that you think is more positive, or is it really just the fact that for a buyer that feels positive in their situation, it's a good news story for them that they can go and drive that bargain? I suppose we're not also expecting values to fall away significantly either, and that can also be a further drag on the economy. Is that maybe one positive thing to take out of here, that we're not expecting all these owners or these buyers or people that have a property to lose their job necessarily, and so then they can't afford their mortgage and suddenly they're chucked out of the market, right? Like the affordability numbers are still relatively positive, so people can continue to afford to keep up with their mortgage payments. We're not seeing massive arrears come out. Is that maybe one way to swing this as well?
Yeah. I mean, for sure, we're at least on a national median, we're still down. I think it's 17-18% from the peak. So I mean, it's pretty deep down to when you adjust for inflation too. It's the last time I looked, it was pushing more above 30% in terms of in real inflation adjusted house prices. So that's a big correction. Now, yes, I suppose they could fall further. I mean, anything's possible, but it feels like the chances of that are a lot reduced, obviously, from where they used to be. So affordability's improved. We've kind of talked about that before. I mean, it's the two sides of the equation thing again. Rents are still pretty soft, so positive for tenants, not so positive for landlords, of course. So always two sides to the equation there. I suppose the other thing is just around the lending numbers. There is obviously the LVR rules were loosened on the 1st of December. If you're a borrower, if you're particularly an investor, there's some signs of some lower deposit finance becoming available there, and people actually willing to take it up too. So that's perhaps a small positive. If you're in that boat, it is more likely that you can get into the market with reduced deposit. And I suppose for borrowers in general, the DTI rules, if you're wanting to get more debt, some people would say that's a bad thing, but if you are wanting to get more debt, those DTI rules aren't really a factor at the moment. We're still running quite a bit below the speed limits. So yeah, I don't know. Maybe there are some small bright spots for people depending on their perspective. But yeah, overall, it's we're seeing that, as you say, the big story is economic weakness. Obviously the wider macro issues, and that's, I suppose, influencing the mood in the housing market too.
On that note as well, actually, and it's sort of the first time I'm probably going on record speculating this, but I do wonder if we get to a situation where I know the Reserve Bank are going to be in a really difficult spot, likely have to increase the OCR because they have to fight against that inflation. They're going to acknowledge the impact it's going to have on the broader economy, but that it's, they have to do that because inflation is the number one target and the main thing they're concerned about. I do wonder, given we've seen some loosening of the loan to value ratio rules, the debt to income ratios, whether we might even see them loosen those up again. Now, in terms of the way they justify that, I guess they could say that there's still capacity for lending to, be broader. It's not as risky. We can't, there's no major concerns here, so there's room to move on those. They could see that as a positive flowing through to more debt, more money going out there, which could help to improve the economy at a time where they're knowingly weakening the economy themselves by lifting the OCR. Now, I have no idea whether that's actually a conversation they would be having, but it does make me wonder if we get later in the year and, there looks like there seems to be room to move in those restrictions and they can lift the speed limit like they've already done with the loan to value ratio rules. They could drop the actual deposit requirement. I don't think they'd necessarily touch that, but, there are some other things they could do here if they're comfortable in our financial stability, but they could see that assisting economic growth. Then maybe that's something they would look at. I don't know if you've got a take on that. As I say, it's sort of the first time that not even on record, I think the first time I've thrown it to you as well. But I just wonder about, when I've spoken at certain events recently and people say, well, the OCR is a very blunt tool. Yes, it's there to maybe help control inflation, but how else can the Reserve Bank affect the economy or help the economy, or how can they, use monetary policy to influence the inflation rate, but not necessarily be so damning to the economy? And it's just me sort of thinking outside the box as to maybe how can they use these other tools to, maybe not be so difficult or tough to the economy, but still achieve their goal of, trying to rein in inflation in those areas where they can. So yeah, I don't know. It's just a random thought that just popped into my mind, Kelvin. Whether you got any thoughts on that?
Yeah, I hadn't thought about that either. I mean, I remember something at the time because it was the rules were loosened, obviously, under the previous governor, Christian Hawkesby. And I think when they did that, he did say something along the lines of they now see it as being kind of neutral. It's kind of just there in the background. They don't intend moving it too much. I think this was more in LVRs than DTIs. They kind of envisaged that's sort of in the background now. They saw their primary sort of macro prudential tool as being DTIs, and the LVRs were sort of just there, kind of doing their thing in the background, where they felt where sort of the settings they've got now were not going to be sort of necessarily binding or necessarily stimulatory either. They're sort of just there. It was something like that. But of course, we've now got a new governor. Times have changed. So, I mean, people's minds can change too. So it's possible. I mean, I suppose just come back to the point, though, that we're operating a long way even below the current speed limits. So, does increasing them do much? Maybe not. I mean, we might see another little step shift. If you increase the speed limit, you see a bit of a step shift. It looks like banks and borrowers do react to that. But there's still so much headroom there now that you wonder sort of whether that's just even a consideration for the Reserve Bank. But possible. We'll see how it goes. Of course, I suppose under the DTIs, you're probably only going to really test those DTIs if interest rates sort of kept coming down, or people had to borrow more because house prices were going up. Now, I mean, with house prices pretty flat, interest rates, if anything, going up rather than going down, it's actually kind of difficult to imagine how we really test those DTI limits in the near term. So, yeah, we'll see how it plays out, but I would be a wee bit cautious.
Yeah, no, for sure. As I say, we'll see. It's just a random thought right now. I mean, the other thing the Reserve Bank talks about was that I think house prices are at more sustainable levels, and that I think allowed them to be more comfortably loosen some of those lending restrictions. So again, if we expect that prices aren't going to go anywhere and those house prices stay at what they call sustainable levels, if income growing and house prices aren't going anywhere, then again, that I suppose means that they're even more sustainable or affordable. And again, maybe they could loosen those limits up and not be too worried about, them causing problems down the track, which I think is their main reason for having them in the first place. So maybe that's one of the things. I wonder about, you're right, in terms of the speed limit itself, maybe not having as much of an impact because they're still well below those. Could we see a lowering of the deposit requirement for investors? That could be something that sees the handbrake on or off a bit more direct than just loosening the amount of lending that can be done at what's called high LVR. If you change what high LVR definition is, we've seen that in the past, whether it's 30, 35 or 40%, maybe that would have an influence too. But anyway, we'll leave that speculation there again. Once more, it's another one we're throwing out there to market. So let's see, we might be able to come back to this one in a few months' time and say we called it way back in April. Or if not, we can just ignore that we called it. But anyway, mate, we will move on. I did want to touch on a comment which was made on Spotify. It was a couple of weeks ago. We forgot to cover it last week. So thanks to Mitchell for throwing this one out there. I'm going to read it verbatim and then we'll just have a go at tackling it. So Mitchell says, "Hey guys, love your podcast. I've been listening for a long time. Just wondering, as a rural real estate agent, are you able to do a rural roundup? Rural interest rates, what's your forecast on that? Would be a huge benefit. Keep it up, guys. Thank you." So, Kelvin, now I want to firstly acknowledge that, we spend a lot more time looking at that residential market than we do going across the rural sector. But I do wonder, I think, we always, we acknowledge the role it plays. When you touched on before, the fact that house prices nationwide are down 17 odd % from peak. We've seen some areas get back to that peak, come back with decent growth. Often we've talked about those areas being the likes of Southland or Taranaki doing better, these areas that are supported by the agricultural industry. So I think there's always an acknowledgement of the role it plays in our economy. The fact that, that's been the area that's done the best in the last few years and helped us to see some economic growth in difficult times. So I think we've got, some awareness of what's going on in that sector. Keen to get your take on this. I suppose just provide us a broad economic assessment of the agricultural sector and the rural parts of New Zealand. I think that'll give us a feel for, what is the expectation on the future? Where does it come from? Where are we expecting the agricultural sector to go in the future? And that is probably something that the lenders are going to be assessing at the same time when they're trying to set interest rates, right? So I think that naturally leads us into what does the conversation look like in the interest rate sector. We know that rural is typically seen as riskier from a bank lending perspective. Partly it's the environmental side. They've got to cover off that, environmental expectations of that rural lending as well. You can go through some of the debt data, I suppose, on that as well. But yeah, where is the economic industry at from an agricultural perspective? What does the future look like in terms of some of those payouts, and how's the global sector seeing our dairy prices as well? And then, I suppose you can wind that into, what influence that might have on interest rates, acknowledging the fact that we're certainly not interest rate forecasters for the rural sector, so it's not going to be an area of expertise for us. And I think then I'll essentially just open it up for other listeners. Do they have a take on this? Are they closer to it? What are they seeing? What are they expecting? What do those conversations with the farmers look like? That can help out Mitchell and anyone else that is more close to that rural sector as to what to expect of the future this year, and noting, of course, dependency still on how long this conflict goes on in Iran and what Israel and US do there as well. But yeah, mate, give us your economic assessment and we'll see how this flows.
Yeah, long story short, I think probably everything I'm about to say, I think probably is on balance optimistic for if you want to see higher rural sales in that way. I think there's a reasonable cause for believing we'll see a few more farm sales, and if you're thinking about it, is it more likely to go down or up? There's a wee bit of positivity there, I would say. So I think that's where I'm going to get to. But yeah, obviously farming's been doing really well lately. High global commodity prices, for milk products and sheep and beef. The arable sector, I understand, is finding it pretty tough going. Global prices for wheat and barley, that sort of thing, are pretty flat. In the meantime, input costs have gone up a lot. Crop farming is very dependent on fuel for driving big tractors and harvesters and things. So it's not like it's universal. So those profit margins are definitely being shrunk. So that sector as a whole has been going fairly well. There's always bright spots and poorer spots, but I suppose everyone now is looking at higher input costs. Even if you're getting good output prices for your milk, there's still higher fertiliser prices, higher diesel prices. So So that's not going to be that positive. Profit margins are going to be squeezed. It's very difficult for farmers to pass on cost increases. They're effectively price takers for almost everything. I would say, apart from maybe some really specialist niche things, but generally you're going to be a price taker. So if your input costs have gone up, it is going to be tighter profit margins. So that's not going to be necessarily supportive for rural sales or farm sales, but yeah, there's some other things going on. We've just had a look at sort of lending figures to the rural sector, and it has been a fairly tight sort of decade for lending to agriculture. I just looked up some stats that if you look at the stock of existing debt that's out there, housing debt is up around 85% in the past decade in terms of value of loans. Overall business lending up about 50%. Farming or agriculture, if they've got it, is only up 10%, and that's over pretty much a whole decade. So, yeah, there's it's been pretty tight for credit. I think in the farming sector, I've heard about different banks sort of maybe even winding up rural lending teams or being pretty keen to just scale that back. They see the risk of default as being a little bit higher, whether that's right or wrong. But either way, they've just been wanting to just scale back a little bit of that debt exposure to the farming sector. But just in the last year, 18 months, I guess with better commodity prices, it looks like that's turning around. So, yes, there's always pros and cons. I suppose the interest rate scenario, farming interest rates or rural interest rates tend to be higher than resi, again, sort of to do with perceived risk, whether that's right or wrong. I hear different views on that, but either way, the rural lending rates are a little bit higher, so that's not necessarily a favourable starting point. If anything, we're seeing interest rates across all sort of types trend higher. So it could be that farmers are looking at higher financing costs in the next little while too, alongside higher diesel prices and fertiliser prices. So yeah, all those things sort of trade off against each other. But you'd think that, people still need to eat. We're still going to do fairly well in terms of exporting of these products. Yes, higher input costs might not help. Higher financing costs might not help. But at the same time, it looks like banks might be a bit more willing to actually advance credit. So that might help drive some sales. People can expand their operations. So yeah, I think as you said, we're definitely not experts on any of this. It's not a day-to-day thing that we're tracking, but it feels like there's some supports there, a few restraints. But if I was making a gut feel on where I thought rural sales were going to go in the next year, 2 years, pending all the things in Iran, but all else equal, yeah, I'd be thinking that they're probably more likely to go up than down. So, bit of a stab in the dark, but those are some of the things in my mind anyway.
Yeah, I don't have too much to add. I suppose just, in a comparison to resi, because we spend so much time talking about residential mortgages, it does seem to me that the outlook for that rural sector is slightly better than the residential sector. So if that remains true and you're in a strong financial position in that rural sector, then, I suppose the key thing would be that, if the banks are opening up and a bit more keen to look at their rural books, then, can you use that strong position to negotiate with the banks, look at changing and make sure that you do get the best rates possible. And that's probably no different to the advice we give for residential mortgage holders as well, is that, right now we know that the competition for their money is quite strong between the banks. And it seems to me that maybe that's true of rural, if we have seen that upturn again in lending to that sector after acknowledging the fact that, over a 10-year period, it probably hasn't been as open or easy to get that money, but for any good creditor, maybe it is a time that you can look to use that power to get the best out of your mortgages across different banks. But yeah, maybe we can leave it there anyway. As I said, keen to hear any extra thoughts or any advances on those conversations, and yep, happy to pass those on or include them in a future conversation as well. So do let us know if that was helpful, if you've got anything to add to that one. But that will pretty much do us for economic property chat this week, Kelvin. If that's kind of the core of why you're here, then you can leave it there, and we'll see you again next week when we'll chat about the April House Price Index or Home Value Index. But otherwise, maybe we can jump into a bit of personal chat over the weekend. As I touched on right at the start, I know that you went to the new stadium, Te Kaha, to see Super Round on Saturday. I think you were there for the Canes and then the Blues game after that. Plenty of intrigue. I had the TV on for most of those games, and just amazing to see a full stadium, and Sky, I think, did a great job covering the whole thing with people across all of the city and just seeing the bars packed and things like that. So it sounds like a massive success by all accounts. I mean, on the field, Leicester Whanganuku being an open side on Friday, and by all accounts doing incredibly well himself, was probably the biggest call on the field. Maybe the Blues golden point win was the other one. But yeah, give us your take on the new stadium and the Super Round.
Yeah, it's amazing. It really was. I mean, the stadium feels, as you'd expect, it's obviously new, but it feels, it's a massive step up. It feels really international. Okay, it's not as big as, Millennium Stadium or Twickenham or whatever, but still feels like that. It's a proper stadium. I doubt there's a bad seat. The second tier or even the third tier, well, they call it a section 3 or something. I can't quite remember. It took me a while to get my head around where all the seats were. But as you get up towards the top, it's pretty steep. So, you want to be a bit careful coming up and down there. But it does mean you're almost looking right down on the field. So you've got the sort of drone view. So I doubt there's a bad seat. And obviously you don't have to deal with wind and rain, and acoustics presumably are really good, keeps the atmosphere in. So it felt like a real good party for sure. And, good rugby on the field, and the stadium's centrally located, easy to get to. There were no queues. There seems like the capacities, all the facilities are about the right size for the number of people there. So, yeah, just amazing. And how the rugby was good. I mean, Hurricanes were easily the best. And, the Blues got that tight victory. So it was good to see some good results. Caught up with some friends there as well. So, but yeah, I'd been to the Anzac dawn service out at Burnham Military Camp up at 5 a.m. And after the rugby went a wee bit later than what I had intended. So I figured out I was almost up for 24 hours. So that's at my age, that's getting a bit too late, really. But it was great occasion. I'm only doing it. I'll only be doing the opening once. So yeah, it was great. So yeah, anybody who hasn't been, I guess it's worth getting down there for sure. And I think the next big occasion, I suppose, will be the All Blacks test against France coming up sort of a couple of months' time. So I imagine that'll be pretty cool too, packed out, and for a test match, it'll be a good event.
Good on you,
Sounds
mate.
awesome.
Yeah. Glad you enjoyed it, and it sounds like you made the most of it. And yeah, I think that's exactly it, right? Like anyone that saw that or anyone that reads any coverage of it is just going to have mass FOMO now and want to go and check it out for an event, whether that is rugby, test, like you say, or concerts, down the track. And I know I've already got our tickets to Foo Fighters happening later in the year at that stadium. So I think the attraction of that now is going to be huge. Questions, of course, do they do Super Round again next year? And it seems like a no-brainer to just do it in Christchurch. Once again, the location, the closeness to the town and the bars, massive success. So yeah, look, just so exciting and cool to see that happen here in New Zealand. Yep, slightly smaller scale, 25,000 or whatever it is, but sounds like it's absolutely perfect. So yeah, the attraction and want for everyone to come and check it out themselves for an event is going to remain high for a long time, I would suspect. So yeah, very exciting, very jealous, and yeah, good on you for enjoying that one, mate. Well, certainly anything I report for my weekend is going to pale in comparison, but yes, and for my personal football season, certainly has been a tough start to the season. We've got a new format for the top 2 Masters grades this year, and we're not going so well in the first few weeks. We lost again on Saturday 6-0, so not ideal. We know this team will be up there at the top, so it is what it is, but looking forward to sort of a regrade of the teams, which happens in about 4 or 5 weeks' time, where I suspect we will not make the top section, and quite gladly so. So yeah, tough start, but still enjoy catching up with the lads, have a beer afterwards, and yep, decent weather again. So after that middle weekend, of course, very difficult. And our game being postponed, we got another game of football on the weekend, and it was a beautiful day. So, and pretty good over the whole weekend, to be fair. So I managed to get out and about with the family and do a few things, and yeah, no real complaints really. And now kids football and netball and things starts this weekend. So yeah, we go again into the winter season, I suppose.
Yeah, awesome. Yep, it sounds like it'll be busy weekends from here on with doubling up on sport and clashes with times and locations and things. So
Exactly.
family life.
Yeah, no, all good, mate. Well, that'll do us for today. Anything else on your mind before I close us out?
No, that's it. Look out for the HVI later in the week. So we'll see if it's slightly up, slightly down, flat. I mean, yeah, interesting results.
Indeed. Yep. No, look forward to it. Well, all good, mate. Well, good to chat, good to catch up as per usual. Kelvin, thanks very much for your insights. Just want to say thanks very much for listening. Please do get in touch with any questions or feedback, just like Mitchell did, whether it's on rural or residential. We're keen to hear from you out there, and let us know any thoughts if you are in that rural space yourself. But that'll do us for today. I just want to say thanks once again. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.